You've been told a lie about Bollinger Bands. A pervasive, oversimplified myth that has likely cost you capital. The lie is this: buy when price touches the lower band and sell when it touches the upper band. This rudimentary approach, rooted in a misunderstanding of mean reversion, is one of the most statistically fragile strategies in the retail trading space. Today, we don't just debunk this myth. We dismantle it with logic and data. Then, from its foundations, we will engineer a robust quantitative trading model designed to do the exact opposite, to systematically exploit periods of low volatility for high-probability breakout opportunities. Welcome to Trade Logic Lab. Our mission is to replace market noise with statistical clarity. Forget what you think you know about Bollinger Bands. We're about to rebuild your understanding from first principles. First, let's execute a clinical takedown of the band touch strategy. The entire premise rests on the idea that prices are statistically likely to revert to their mean. The 20-period simple moving average at the center of the bands represents this mean. The upper and lower bands, typically set at 2 standard deviations away from the mean, are supposed to represent levels where price is overextended. Therefore, a touch of the upper band suggests an overbought condition, ripe for a sell-off, and a touch of the lower band signals an oversold condition, primed for a rally. This logic collapses under the slightest pressure of a directional trend. In a strong uptrend, price can, and frequently does, walk the band, riding the upper Bollinger Band for extended periods. Treating each touch as a sell signal is a systematic way to exit a winning position prematurely, or, even worse, to initiate counter-trend short positions that get systematically run over. The bands do not define absolute barriers. They define what is relative. A touch of the upper band in a powerful trend doesn't mean the price is too high. It means the upward volatility is strong and sustained. You are fighting the very momentum you should be seeking to harness. To understand the correct application, we must understand the mechanics. John Bollinger, the creator of the indicator, has stated explicitly that the bands are not direct signals. They are a tool to frame price action in the context of volatility. The bands widen when volatility increases and contract when volatility decreases. This is the key. The most potent information Bollinger Bands provide is not about price level, but about the time state of volatility itself. And that brings us to the core of our system, the Bollinger Band Squeeze. Think of market volatility like a coiled spring. Periods of low volatility, where price consolidates in a tight range, are periods where energy is being stored. The market is building cause for its next significant move. When volatility is low, the standard deviation is small, and consequently, the Bollinger Bands contract, squeezing closer and closer together. This squeeze is a quantifiable warning sign. It signals that the market is transitioning from a state of equilibrium to a state of imbalance. An explosive expansion in volatility, and therefore price, is often imminent. Our job as systematic traders is not to guess the direction of the coming explosion. It is to build a model that objectively identifies the setup and provides a clear trigger for entry once the direction is revealed. This is the Bollinger Band trap. We are setting a trap, waiting for the market to signal its hand. Let's engineer this system, rule by rule. We need a precise definition for every component: the setup, the trigger, the filter, the stop loss, and the exit. Rule 1. The setup, quantifying the squeeze. We need an objective way to measure low volatility. For this, we use an indicator called Bollinger Band Width. The formula is simple: middle band value. This gives us a normalized measure of the distance between the bands. A low BBW value means the bands are tight. But how low is low? We define it relative to its own recent history. A common method is to identify when the BBW drops to its lowest point over a specific look-back period. For example, the last 126 periods. When the BBW hits this new low, our system is armed. The trap is set. We are now in a squeeze condition and are actively monitoring for a breakout. Rule 2. The trigger, the breakout. The squeeze only tells us that a move is likely. It does not tell us the direction. The trigger is what springs the trap. Our trigger is a decisive close of a price candle outside of the bands after times the squeeze condition has been met. For a long entry, we require a candle to close above the upper Bollinger Band. For a short entry, we require a candle to close below times a lower Bollinger Band. This is the moment of commitment. The volatility expansion has begun, and the market has revealed its intended direction. This is a critical distinction. We are not entering when price is consolidating. We are entering when it breaks out of that consolidation. Rule 3. The filter. Confirming the regime. A raw breakout system can be prone to false signals, especially if it's against a dominant, long-term market trend. To increase our probability of success, we add a regime filter. A simple and effective filter is a long-term moving average, such as the 200-period simple moving average. The rule is, we only take long trades if the price is currently trading above times the 200 SMA. We only take short trades if the price is currently trading below times the 200 SMA. This ensures we are trading in the direction of the primary market tide, using the squeeze to pinpoint a high probability entry within that larger context. It prevents us from shorting into a powerful bull market or buying into a persistent bear market. Rule 4. Risk management. The stop loss. No system is complete without a non-negotiable risk management protocol. A logical place for our initial stop loss is the middle band, the 20-period SMA. If we enter a long trade on a breakout above the upper band, our stop loss is placed just below the 20-period SMA. If price reverses and closes back below this mean, the thesis for an immediate, explosive breakout is invalidated, and we exit the trade with a small, predefined loss. This keeps our risk contained and prevents a failed breakout from turning into a significant drawdown. An alternative is using an average true range multiple, placing the stop, for instance, 2x ATR below our entry price. The method must be chosen and applied consistently. Rule 5. The exit. The take profit. Profit-taking logic is just as critical as the entry. A simple and effective method is to use a fixed risk-to-reward ratio. For instance, if the distance from your entry to your stop loss represents 1R, you could set a take profit target at 2R or 3R. This ensures your winning trades are significantly larger than your losing trades, a cornerstone of long-term profitability. Another dynamic approach is a trailing stop. For a long trade, you could trail your stop loss with the 20-period SMA. You remain in the trade as long as the upward momentum continues, and only exit once the price closes back below the moving average. This allows you to capture the majority of a strong, sustained trend move. Let's synthesize this. We have engineered a complete system. 1. Time setup. Asterisk. We wait for the Bollinger bandwidth to hit a 126-period low. The system is now armed. 2. Times filter. Asterisk. We check the 200-period SMA. If we're looking for a long, price must be above it. For a short, price must be below it. 3. Trigger. Asterisk. We enter on a candle close outside the bands, above the upper for a long, below the lower for a short. 4. Time stop loss. Asterisk. We place our initial stop below the 20-period SMA. 5. Times take profit. Asterisk. We exit at a predetermined risk-to-reward target, like 2-to-1, or use a trailing stop. Look at the difference in logic. The amateur approach is reactive and ambiguous, attempting to pick tops and bottoms based on a flawed assumption. The professional, systematic approach is patient and precise. It waits for the market to build energy, waits for it to signal direction, and then executes with a predefined plan for both risk and reward. We are not predicting. We are reacting to a statistically significant compression in volatility. We are trading the expansion, not the containment. This system is not a holy grail. It will have losing trades. The objective of systematic trading is not to win every time, but to have a positive expectancy over a large sample of trades. This means your wins are mathematically larger than your losses. The Bollinger Band trap is a framework. The parameters. The look-back period for the squeeze. The moving average for the filter. The exit strategy must be rigorously tested and optimized for the specific asset and time frame you are trading. Never take a system you see online and trade it with real capital without doing your own due diligence and backtesting. The logic is what matters. The principle of volatility contraction preceding volatility expansion is a universal market dynamic. It is present in all markets and on all timeframes. By building a system around this core principle, you move away from subjective guesswork and into the realm of quantitative, probability-based trading. You stop falling for the Bollinger Band myth and start exploiting the Bollinger Band trap you've engineered yourself. This is the level of analytical depth we pursue here at TradeLogic Lab. If you are ready to move beyond simplistic strategies and build a truly logical foundation for your trading, then ensure you subscribe and activate notifications. We break down the market's machinery, one system at a time.